Today I have 5 swing trading strategies for you that you can use on commodities such as gold, but also Forex, crypto indices and any other market. So let's get into the first example, and we're going to take a look at primary trend shifts. And those are very important situations for trend following traders and for swing traders, because we can often anticipate trending changes very early on, and that will help us position ourselves in a most effective way early on in a new trend. And as swing traders, we want to ride trends as long as possible. So let's step by step analyze and dissect this chart. What we can see clearly is that we came from an uptrend and then we put in here this top. We have a trend line here when we connect the lows, and what we can see is we are trading around the trend line. And this is already not a very bullish sign, because what you generally want to see in a healthy uptrend, that the market moves back into a trend line or at least comes reasonably close and then moves away from it. When this is not the case, and when the market is not able to get away from a trend line, and that's our first sign that the market is not very bullish anymore. We can also see that we put in the triple top here, which is also clearly a sign that the market is not able to continue higher. Previously, the market was easily and effortlessly able to make new highs. We also see that the market is trading at 1800, which is a big round number, and a lot of traders during trending markets, especially swing traders, they use those big round numbers as mental shortcuts for exits. And even if you don't use a round number as an exit, if you see that the market moves higher in an extended trend and you see that there is struggle at such a big round number, you will start doubting your trade and you may be more likely to close out a position then. Then what we can also see, we have the higher time frame RSI divergence. This is the 4-hour RSI, and whereas the price action makes higher highs every time, the RSI shows us that we have lower highs on the RSI, which is clearly a sign that the market is exhausting, and then RSI divergence means that the trend is losing strength, which we can also see from other factors. But this gives us another piece of information. We can also activate our weekly pivot points, and you can see this is where the trend started. Here's the first time we got above the pivot point, we rejected it as support, traded away from the pivot point. Here on the next pullback, didn't even come close, we move away from the pivot. Here's then where we actively reject the next one. This is where the new pivot opened, we move away from it, and this is our new pivot point. We don't have a lot of information now, obviously, the pivot point just opened here, so we have to analyze and observe what the market is doing around it. What we can then see afterwards is a very clear bearish signal. We are breaking out of this range here, we're getting below the support, and we are also decisively breaking below the weekly pivot point. This is a very different picture from any other pivot rejection or pivot point behavior that we've seen in the past during the uptrend. We are now, first of all, below the trend line. We have been not able to get above the triple top. We are below the pivot point. We have cleared the range, and we have a very strong bearish push. We also reject previous support as resistance. So for trading plans, you have a few options. What you can see is that we are now putting in this local low. And on those trending shifts, what you can see is that this will sometimes take a little while to unfold. Remember, gold is one of the most heavily traded markets in the world. And there are hundreds of millions, maybe even billions of dollars being traded here. And you can compare it to a moving train. A very quick, big moving train is not able to turn on the spot, but it does take some time to slow it down and then to reverse it. And this is exactly what happens on those big primary trend shifts as well. It does take time for the market to reverse. And what you cannot reasonably expect, to see a market turn around and then suddenly completely break out and never look back and only move in one direction. It is very common to see the market go back and forth around those areas. So now we can come up with trading plans. If the market gets below this low, we could go short, because that's a very clear bearish sign. If the market falls back into the range, we are neutral. We are neither short nor long. We are neither bullish nor bearish. And if we get back above this, we would turn more bullish than bearish. So this is how you create a trading plan. And I would always recommend to ask the question, what would make me bearish, what would make me bullish, and what is a neutral sign? Because this helps you avoid the confirmation bias and it will help you stay more flexible. What you can see afterwards is that we cleared the high but fell back here then into this area. And this is a very, very typical example. I have another one later where we talk about stop runs on swing trades. And this happens quite often. What you can see is that we still made lower highs, which is a good signal. We never challenged the previous support or resistance area, and then we cleared the low. As I said, it does take time to reverse those major primary trends. So don't be too aggressive with your stop loss. If you get in on the short here, put your stop loss back in the range, give your trade some room to breathe. don't suffocate your trade. That's very important, especially at those big turning points. In the next example, I will talk about pullbacks. And on pullbacks in established trends, we can be a little bit more aggressive with our stop loss because often the market is already moving. But in this case, when the market is not fully on the move yet, we have to be more cautious with our trade and our stop loss. And then you can see afterwards the market continued the rhythm. We break below support, we retest it as resistance, we break below support, retest as resistance, and the trend unfolds. So those turning points are very important. They're also quite challenging in the beginning, but if you expose yourself to more examples, they will become second nature. Second, let's take a look at pullbacks. And when the trends unfold, I have talked about this so many times, the market doesn't go up in one straight line, but there's always this back and forth. We have a trending phase, impulsive phase, trending phase, impulsive phase. And here, our moving average channel can come in very, very handy. This is the 20-period channel. And what you see is that during trending phases, the market pulls away from the channel. And then during pullbacks, we get back into the channel. We trade away from the channel, get back into the channel. Trade away from the channel, get back into the channel. Get away from the channel, and so on and so forth. And what you often can see is that those periods where the market moves back into the channel, they often come with a pattern. So we can use, for example, trend lines. Here, for example, we use a diagonal trend line. Here we have a horizontal trend line, horizontal, diagonal trend line. And we are going now, this is the 2-hour time frame, but we can go down to a lower time frame. So if on the 2-hour time frame you see that the market is pulling back into a moving average channel, then you could go to the lower time frame. And here we are on the 15-minute. We're looking at the same channel. This is the higher time frame channel. And you can see when the market moves into the channel, we get this very nice pattern here. Here as well, we have this clear, very perfectly well-defined resistance level. And then you can use that as a breakout tool. Once we get above this, once we're closing above it, continuations often occur. Now we're looking at the next ones. You can see we have a nice inverse head and shoulder, the left shoulder, the head, the right shoulder. We have a good resistance level. We break out, continue higher, move back. We retest the neckline here as support. Previous resistance becomes support. We are back in the channel. We have a trend line, break out, continue higher. So you can even use that as a multi-time frame approach. And this works reasonably well with the moving average channel. If you go to the lower time frame, make sure that the moving average channel stays on the higher time frame. But in TradingView, you can easily set this up. Now let's take a look at different trend continuations. So here, what we have is an impulsive wave. We move below the moving average for quite some time. We are very well respecting the moving average channel. Then you have your pullback. The market is not able to continue on the downside. We're not pulling lower. We're moving a little bit higher. We're putting in this very nice resistance area. And here to the downside, we can either use the horizontal level or also look at it with this diagonal trend line. Another very important thing is that you look at the duration of the different trending phases. What you want to see is typically that your pullback phase is not taking very long. And I've talked about this in the past. When you see that a pullback phase is going on and on and on, and it's really, really taking forever, often that's not a good sign. Often this then turns into a distribution or accumulation where the continuation is not very likely, but a reversal into the opposite is more likely. So here you can see we have 69 bars on the downside. Roughly, we could also count from here, so we have a few less candles. But the point is that the consolidation here is much shorter, and that's really what you want to see. Also, another thing that is important, you don't want to see a consolidation or pullback that is very deep, that goes very, very high. You don't want to see that. So those are very important factors. I have a few examples later, or at least one example later, where we're going to take a look at different ones as well. And then what you can do, very classic, just wait for the market to clear the structure. We want to see the market breaking out. We want to see it clear some structures. Also, what is often a good signal is a strong breakout candle. That signals really the momentum shift and the continuation. The bulls are withdrawing. Whoever tried to buy here, they didn't find the majority, and the sellers are now back in control. And then you can see afterwards the trend unfolded. The moving average channel held very nicely. Then the market broke the moving average channel. And what happens afterwards is that we traded around it. So breaking the moving average channel, especially in such a context where previously during trending phases, the channel was respected so well and so nicely, that's a good signal. In the first example that I've shown you, the moving average channel is not very well respected. So in this case, I would not put so much emphasis on the channel, but I would put more emphasis on, for example, pivot points and swing highs and lows, because it seems like gold is really paying attention to previous swing lows and highs. But some markets, some of the time, really respect their moving average channel, and then we have to use that. So you can play around with different tools, and that's why I always include various different tools, because you cannot use the same thing over and over again. Sometimes the channel will work better, sometimes the pivot points work better, sometimes just looking at swing highs and lows works better. But you have to be selective and just see the current market that you're looking at, what is the tool that we are respecting, and then you can use that. Next, let's talk about trend exhaustion. What we have here is a range. We are looking at the market moving sideways. We have here 2 support touch points, and we have a very long sideways range. When we zoom out, what we can see is that, very similar to the previous example, we have a trend and the market moves sideways. But what the big difference is, if we look at the duration, here you can see we have roughly 85 bars, and here we have 166, which is pretty much double of what the trend was. And this is clearly a very different picture of what we have seen previously, where we had around 60 and then whatever it was, 50 or 40. Here we have twice as many, and at that point a continuation is not very likely, because pullback periods that are shorter and then lead to another breakout, they often show and they often provide a much clearer understanding that the bullishness in this case is not really there. The bears are very easily able to take control once again and push the price further into initial downtrending direction. But if this is not happening, if the bears are not able to get below that very quickly, that's not a good sign. But here what we can see is the market is breaking out, and now I would very carefully look at what is happening. We can zoom in, and here you can see we have here a divergence, a double bottom, and we are falling back into the pattern. We break and retest the previous pattern. You can see this is the area that we got from the support, but it's also a very important area on the resistance, right? Support turns resistance and then again into support. And if you see that break and retest back in the pattern with the context of the large sideways period where the continuation is not likely, that's very important. You could trade this back into the range here at this point. You often will not get a huge winning trade, because usually what happens is that the market will stay somewhere inside of the range instead of completely changing trend directions. But this can also be turned into a trading strategy where you look for moves back into previous highs or other tools that will help you pick exits. Let's take a look at trend reversals. Now we are on the daily time frame, and what we have here is a yearly high. So this is the highest point that we have observed during the previous year. And those are just very important points. Also, what is very important are monthly highs and lows, weekly highs and lows. And if you're a day trader, I would also recommend take a look at daily highs and lows. Those are very, very important reference points. Many traders will have them on their charts. And what we can see is we come from an uptrend, we move down, and we are back into this area. Now I would be really cautious and see what is going to happen. At this point, I have no idea what will happen, but whenever the market moves back into such an important high or low, that's where you should start paying attention. You can just map those areas out on your charts and then just wait and put price alerts on them and observe what the market is going to do afterwards. What we see here is clear exhaustion, right? After the market pushed into this high, the next candle was pretty much an engulfing candle. We tried to recover, tried to come back, but then almost another engulfing candle came in. Very, very strong selling candles. At this point, what you could do is jump to the lower time frame. This is what this situation on the daily time frame here looks on the 4-hour time frame. We have lower highs, we have a beautiful trend line, we have a very well-defined support and resistance area. Again, round number 190, very important. A lot of traders use round numbers just as a mental shortcut. So those areas are just very, very well respected. And then what you can see, a breakout, we have a stop run, liquidity run, still a lower high, which is very important. We don't get even near to the previous high. Break, retest, stop run. And then this is where you want to look for continuations. When the market gets below this area now, that's where a lot of breakout traders will get in. So I've mentioned it many times in the past. I would not recommend trading the initial breakout. Those still may provide some profitable opportunities some of the time, but the tendency to those stop runs, it's just so common. And what you can see is also when we extend this trend line, the trend line will also go from being used as support to being resistance. We have the stop run, and then we have the next consolidation. And if we get below this area, that's where you can often expect a big trend push. So be patient. Those trend shifts where we go from one trend to the next, they don't happen very quickly. Often you need patience, just like what I've shown you in the first example, right? It's not easy to completely reverse such a huge trend, especially when we are on the higher time frames, or when we look at those most actively traded markets, gold or any other major market. There's a lot of buying and selling. There are millions and billions of dollars being moved on big markets. So you need to give the trends time to change. The buyers need to get out, the sellers need to get in, and this unwinding and repositioning just takes a lot of time. And so don't be too greedy. Don't be impulsive. Wait for your chance. As a day trader, patience is one of your most important skill sets that you have to develop. But if you're exposed to those trend reversals or to those patterns in general many times, then over time you will learn and understand how those work, and you can trade them with more patience.